Ladies and gentlemen, on behalf of Kaptify Consulting Investor Relations team, I welcome you all to the Q1 FY27 post-earning conference call of Brand Concepts Limited. Today on the call from the management, we have with us Mr. Abhinav Kumar, Whole-Time Director and CEO, and the management team. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, this is a reminder that this call is being recorded. I would now request the management to detail us about the business performance highlights for the period ended June 2026, the growth perspective and the vision for the coming years, post which we will open the floor for Q&A. Over to the management team.
Hi, am I audible?
Yes, please go ahead.
Okay. Vinay, I'm actually joining from another system. There is some system problem. So we'll just log out and we are joining again from another.
Yes, sorry. Sorry for the initial glitch here. Okay. Hi, good afternoon, everyone. Just a round of introductions. I'm Abhinav Kumar. I'm the Whole-Time Director and CFO of Brand Concepts. And I'm joined with, on my left, Mr. Kalyan Maheshwari. He is President, Finance and Accounts. Ms. Swati Gupta, she's the Company Secretary. And on my right is Mr. Manish Peshwani. He is Vice President, Commercial. So welcome everyone for the FY27 Q1 post-earnings call, and thank you all for taking out time and joining the call. So just giving a summary, we've in terms of the revenue, we've grown by almost 11%. Our EBITDA growth is also very good, owing to the revenue and also reduction in certain expenses that I'd informed earlier also that we are working on reducing certain overheads, certain expenses, optimizing our resources. So all that has led to healthy EBITDA growth as well. The bottom line, the PBT loss has widened marginally. It's again continued pressure from higher depreciation, interest cost, and other operating investments. Giving an outlook of the from the sales perspective, we've been consolidating in most of the channels, focusing on the sustainable, better margin growth rather than just chasing a higher top line. So there are certain consolidation exercises that we had undertaken, and very happy to share that things are going as per plans. One major restructuring that we've done is in our e-commerce, where certain high volume SKUs were realigned to certain channels. This is pertaining to a long-term strategy of sustainable growth. And hence, momentarily in this quarter, we have probably suffered some dent on our primary billing. However, our secondary continue to be strong. So very confident that we should be able to bridge this gap in the coming quarters. Even in terms of modern trade, our focus is more on focusing on high throughput counters, where our we are healthy at the bottom line. There still seems to be a lot of challenges in terms of pricing pressures and new incumbent players coming into our category, specifically when it comes to the travel gear category. The pricing pressure still remains to be there. External conditions are not very, very buoyant. At the same time, it is further fueled with war situations which have escalated the cost of raw material also to go up. At the same time, curbing travel or reduction in travel is being seen. However, in spite of all of this, we are very, very happy and proud to share that we have not lost market share. On a secondary basis, we have not lost market shares. There are a lot of bigger companies and in the premium space who have lost actually market share to new incumbent players, but thankfully our company has not lost any market share. So which is a very silver lining in the this thing. Another this thing is we have been consolidating our bag line. Last time also I had mentioned that we feel that single monobrand stores are going to be more healthy for us. So we've been consolidating on the bag line. We've closed down certain stores which were not profit making, which were the bottom end of this thing. So long story short, in retail, every now and then you need to clip your tail, and we've successfully undertaken that whole activity of clipping down the tail so that we remain profitable. The focus is on optimizing the balance sheet, optimizing our resources, and very confident that we are en route to that. With this, we can open the session for Q&A.
Thank you. All those who wish to ask the question may use the option of raise hand. In case you are unable to raise your hand, just drop your question in Q&A box and we'll ask on your behalf. We'll take the first question from Ankit. Ankit, you can go ahead.
Yeah, thank you for taking my question. This is Ankit Kanodia from Zen Nivesh. So I really admire your philosophy of not going with what the general D2C players are doing in the market. Just wanted to understand, given that they have the financial muscle power and the way we have shared in our presentation about expanding to categories where probably we are entering into those categories where these guys are not there because they are majorly into, I've been to some of their stores, they are majorly into luggage, and most of their luggages are sold through e-commerce at hefty discount. So
Right.
is it right to assume that increasingly our revenue will have more share of non-luggage items going forward?
See, I believe it's not that our luggage will not grow. We foresee that, or we are very, very optimistic that even our luggage business will grow, right? In fact, as a matter of fact, from the last Q1 to this Q1, we have in fact grown in luggage, right? But the growth is probably low single digits growth in luggage. Overall travel gear, we are sort of in negative, but not because of luggage, because of backpacks where certain SKUs we needed to consolidate, certain high volume but low throughput or low margin items were we had to take a call and discontinue a few of them. But otherwise, luggage has been growing. But to answer the question in a broad way, luggage will keep on growing. I don't see a rhyme or reason for that. But current trend is that discounting is the way to lead, right? With all these new players coming in and sitting on a lot of private equity money, the idea is to grab market share from their side, right? They want to grab market share at even if the pricing is unsustainable, even at that price, they want to grab that market share. We haven't taken that route yet, and we don't intend to take that route. We don't want to do anything which is at unhealthy pricing. Our new hard luggage plant gives us the opportunity to compete with a lot of these players at a fair price, market price, right? So that is a route that we are taking. Backed by our manufacturing, we'll be able to compete better in the market. And but apart from this, the other categories we see strong momentum, and hence we keep pushing on it. So I believe going forward, it's not one category getting marginalized over the other. I think we'll see a combined effect of all the categories coming together.
Yeah, that was very helpful. My next question is, see, we have our advantage in terms of manufacturing, but when it comes to sales and especially sales channels, the two big sales channel which we have, one is the modern trade and the other one is e-commerce. And I think it is very difficult to escape the competition there from these D2C players. And if they are in the game of reducing their price point, how do we manage to still follow our philosophy of not going down that ladder of reducing price and yet manage to increase our sales? That is area which I am unable to figure out.
So, if I tell you, for example, in terms of travel gear, if I talk about modern trade, so if I talk about, for example, Shopper Stop, our growth this year from last year has been upwards of 12%, right, at the secondary level. Primaries, we are, as I said, we are trying to optimize every counter. So if there is excess inventory anywhere, we've been trying to optimize all of that. But our secondaries continue to be strong. See, the biggest challenge that one has in travel gear versus the other categories. Now there is a luggage available for as low as 900 rupees, right? So the question is, how will we be able to sell a luggage for 8,000, 9,000 rupees, correct? Now, if I take a parallel example of, for example, the apparel category, there are shirts available for 200 rupees also, right? You get a round neck t-shirt in Decathlon for as low as 300, 400 rupees. And it's a decent quality t-shirt. It's 100% cotton, decent quality t-shirt. But then people are ready to pay 1,500 to 2,000 rupees for a US Polo t-shirt. They're ready to pay a 3,000 rupees, 3,500 rupees for a Tommy Hilfiger t-shirt. They pay 8,000 rupees for a Hugo Boss t-shirt. So it's not only about buying that product, it's about the perceived value of buying a brand, right? Sadly, in our category, specifically in travel gear category, nobody has focused on, let's not talk about anybody else. I'm saying, consumers are still not that brand savvy, right? The brand penetration is still at a very low percentage level of the entire consumer base. But today or tomorrow, this is bound to happen. Today, you might, you might shift. A consumer might shift from a unbranded to a branded, buying a branded 1,500 rupees or a 1,200 rupee luggage rather than buying an unbranded. But eventually, all these consumers will aspire to grow ahead, right? And touchwood, if I talk about, for example, Tommy Hilfiger, we've launched some, high price point, premium price point products. We've launched products at 32,000 rupees a set of 3. We've launched product at 27,000, 28,000 rupees a set, where the competition is selling. Your mass brands are selling at 4,000 to 6,000, 8,000. Even your new age players, premium brands, they are also selling for 12,000, 13,000, 10,000 for a set. And our top sellers by volume also, in our top sellers, the 27,000 rupees set, the 32,000 rupees set comes in our top sellers. So I would say that, consumer today is very, very discerning. He understands the value that they're getting. So if at the premium end of the market, I believe there is still a resilience which the consumer has. And I think we should be able to capitalize on that.
Thank you so much for the elaborate answer. My next question was related to, ultimately any retail business which has retail stores like ours,
Mhm.
they report triple SG, same store sales growth.
Yes.
Any idea or any plan of doing that? I think our presentation is very detailed. I should congratulate you and your IR team for those details. But if you can just include triple SG also as a metric, I think that would be very helpful.
We will. See, right now what is happening is we are also, as I said, this year is a year where we are also looking at certain consolidations, clipping of our tail. So once we've done all of that, I think we'll be in a much better position to share that information with all of our investors. And I've always maintained, all of us at Brand Concepts, we maintain that transparency, so I don't have a issue in sharing that. So we will probably, going forward, but give us a couple of quarters, and we should start sort of putting a matrix together so that we are able to give you guys the correct picture on same sales, same store growth.
Great. Sir, one last question before I go back to the queue. In our presentation, in one of the slides, we have clearly highlighted phase one, phase two, phase three. Phase one is the foundation building, which is already done. Phase two, which
Yes,
is the platform expansion, which we are under. And phase three is
yes.
the operating leverage. I'm not asking for a definite guidance, but conservatively speaking, sorry,
So you,
how many quarters down the line do you expect us to move into the phase three?
I think phase three would happen. If I speak conservatively, about 1.5 years from now.
Okay. Thank you so much, sir. I'll come back to the queue if I have more questions. Thank you and all the
Certainly.
best.
Thank you. We'll take the next question from Nesar Parekh. Nesar, you can go ahead.
Yeah, hi.
Hi,
Thank you.
Nisar.
Hi, Abhinav. First of all, I just wanted to get your, update on the Tommy Hilfiger license.
Yeah. So I think there is a delay from the international counterpart. But we have been promised our business plan and everything is approved. So if I can actually mention this, that we've got an assurance from the India team. Even the India team has not received their renewal. So as soon as they receive, it's Tommy International giving the rights to Tommy India, giving the license to Tommy India, Tommy India giving the license rights to us. So the license rights of Tommy India is also not done yet. But I'm given to understand it is just a paperwork, and we are very, very confident that our business discussions, business plans, uh, all of that is already done and closed.
And
So
last time we had a 3-year license, and you had mentioned that this time you will try for a longer 10-year license. So just from a broad contractual perspective, in terms of both the duration as well as the terms like royalty, etc., where does it stand? What will be different and same?
yes, so um, okay, I can officially on record say this, that our 10-year business plan, royalties, figures, numbers have been closed. So it's just the paperwork that we are awaiting.
And the royalty will be, is there any
Same,
step? It'll be same.
same.
Okay, got it. Okay. My second question is on manufacturing. Now it's been, I think, maybe a year or plus. So just where do we stand in terms of our utilization? How much share are we, doing in-house outsourced? And
Yeah,
we were expecting margin benefits to obviously come in. So if
yes.
you can, give us a bridge kind of thing to say that how much benefit has come in and how much of that we have had to pass on to the channel either as pricing or discounts. That'll just give a sense of the manufacturing benefit.
See, so it's at the first phase of manufacturing. We set up the PC unit, and very happy to share that we are already at a 80% plus sort of a utilization of that. Currently, the entire thing is internal consumption, right? We have yet not started producing for external clients. The second leg of the manufacturing investment was on PP plant, on one PP machine, right? So we've taken one PP machine at the moment. And that also, as we speak, trials are done. We are beginning with the production. By at best in the next 2 months, I think we should reach 75-80% capacity over there also. So to put in perspective, the PC unit has about a 25,000 kind of production capacity, and same would be a PP, right? So both together would be about a 50,000 capacity. Today we are operating already at a 20,000 capacity plus, and by October or latest by November, we should start reaching about a 40,000 pieces a month. In terms of margins, we are seeing a benefit. In fact, if I, internally we do a SBU kind of this thing. Very happy to report that the plant is positive at a 20,000 level itself. Which we had earlier anticipated that we'll take at least 35,000 units for the plant to sort of break even or make money. But we've been able to do that in 20,000 pieces itself. In terms of what sort of EBITDA, see, it becomes very difficult because it's all internal, right? So it's all internal consumption. So, how do you take this? What do you load over there and what do you load over here? But I believe that at a 40,000 pieces, I think, the plant individually, if it was not supplying to brand concepts, we would have easily made between 11%, 13%, approximately a 12% kind of EBITDA at the plant level. That gets passed on to brand concepts. How much are we passing on to the in terms of pricing? I would say a bulk of it today. To stay relevant, to get this thing right, we are passing on bulk of it in terms of our pricing to the end consumer at the moment. But I believe once things start to settle down, see, there are 10, 15 new players who have entered, who are currently flush with money. Everybody is clamoring for growth. But do you think all 15 of them are going to survive? They're not. So it's a matter of time. Rationalization will start happening in terms of pricing. And that's when we'll also start seeing the true benefit.
Right. My next was, in terms of just like you said, they are flushed with money, right? And in competition, if we are sitting with debt and whatever our EBITDA is completely going into interest, so our operating cash flow, investing, we are completely negative. Now, to what extent can we, sustain this? At some point, we are already closing stores as we speak. So, what is our capital plan? Because, we can't assume they will run out of money in 12 months. Maybe even we will. So,
Right.
what do we do? Like, what is our plan over the next 2 years in terms of the capital?
See, even if you look at last year, Nisar, our Q1 was negative, but we ended the year at a positive bottom line, right? Or I would say, let's call it a break even. We were just, I think, around 1 crore plus. But this year, Q1, negative does not mean that my rest of the quarters are going to be negative, right? So, as I said, we've taken some consolidation exercises, which is a temporary sort of you call it a short-term sort of a hit that we've taken. But I'm pretty confident that we'll be ending up very healthy this year. So, in terms of cash running out or money running out, I don't see that happening because I think we've already bottomed out. From here on, our working capital cycle is going to go better. From March to Q1 itself, our stock has come down. So we have almost 4 to 5 crores of inventory, which has come down, stock holding, which means, that 5 crores extra cash flow has come into the system. So I think we have enough and more leverage right now. I don't see a point of neither we are short of capital, nor I foresee that we would need a lot of capital. Yes, whatever debt was available at that time, we've taken that debt to fund the growth. And I think we have healthy margins which will be able to cover this debt. From a long-term perspective, probably once we are absolutely fine, we are absolutely good, we also aspire that probably 5 years down the line, we'll be a debt-free company. But that's a long-term vision that we have. At the moment, I don't think, money is a constraint where we will not be able to sustain. Closure of stores is not because we don't have money. Closure of stores is because those stores were draining money. So we're cutting down on our losses.
No, fair. Sorry, just if I could just follow up. What I meant is that, do we plan to get some more firepower, because we might be breaking even, but from a operating cash flow, we are, obviously negative. So do you have any capital raise plans? Do you think infusing some equity, does that help to give us the firepower to actually fight? And when we are more in a growth mode, because obviously we have a bunch of brands that we've taken. So just from that perspective, I'm asking that, does capital pose a constraint to growth, which otherwise you would have done if you had more capital?
No, so we did, the promoters have already infused money when we needed the capital for new brands, and it was primarily taken for new brands. And we infused 20 crores of promoter capital. Out of the 20 crores, I think 15 crores is already into the system. So when we required, we funded it. And promoter himself putting in the capital goes to prove that, that we are absolutely confident of the story of how we're going.
Got it. Okay, I'll come back in the queue. Thanks, Binav. Thank you again.
Sure. Thanks, Mr.
Thank you. We'll take the next question from Resha Mehta. Resha, you can go ahead.
Yeah, thank you. I hope I'm audible.
Yes. Yeah.
Yeah. So, on the consolidation bit, right? If you can just, talk about that for each channel, when did we begin this consolidation journey and how far are we into, let's say, are we nearing completion of the consolidation in each of these channels? And yeah, maybe I will ask my second question after this.
Good. You want to ask the second question right away, or?
No, I'll wait for your response. So probably it'll be more of a follow-up. So.
Okay. So, see, every channel, retail as a business, or I would rather say every business, it's a cyclic process, right? So you have expansion, then you have some consolidation, and then once you consolidate, and then you again get into an expansion, right? So it's not about one particular channel that we are consolidating. It's across all the channels, right? So we've had a good run for the past 3 to 4 years, we've expanded into multiple stores, multiple categories, multiple channels. But we are not a company which is chasing only top line growth, right? We're very, very focused that we need to have a healthy balance sheet, we need to have a healthy bottom line. And in order to do that, every channel will have some, superheroes and some villains. So you need to clip the villains every channel. So we take that as an exercise, and we keep strengthening ourselves. So there might be a particular, for example, in e-commerce, there might be one particular SKU which might be giving you 10-15 crores of revenue, but you feel that somewhere that SKU has now outlived its age. You want to change that, because as a brand, you need to have that health check also in place, correct? So you have to take those calls. You might have to let go of some short-term benefits, but keeping the long term in mind, you will have to take those calls, to protect the brand.
Sorry, Abhinav, my question was actually in terms of the timelines. I appreciate the reasoning behind the consolidation. I think that's mentioned in your presentation also. Like, when did we start off this consolidation journey, and how far away are we from nearing completion in each of these channels? And also in terms of and also in terms of your retail stores. So I think the number of closures are pretty sizable, right? And with new additional 9 stores on notice. So when do we see this consolidation coming to a closure across channels, and probably then can we expect growth to come back? So that really is the context of asking this question.
Okay. Yeah. So we embarked on this, I think, last year, Q4 onwards, January onwards, we started sort of, we said, this season we're gonna take on the consolidation drive. So we've started on that, and I think we are almost at the moment, I can safely say, and Manish or Mr. Maheshwari can actually comment on this, but I think we are almost 80% through, 75-80% through.
Yes, by September, Joby stores we have decided will be out of it.
Okay. So by September, I think we should be through with this. E-commerce, as I said, we've already whatever new listings that we had to take, we've already taken that. So hopefully from this month itself, we are now sort of getting back on track in e-commerce. Certain old redundant SKU styles have been done away with. Channel strategy is in place. So e-commerce, we are getting back within this month itself. We starting to see the results. And from modern trade perspective, I think by September we should be done with all of this. Then going forward, it will always be a continuous process, but it will not be at a scale probably that we've done it right now.
That's right. So, which means that at a company level, we should probably get back to growth October onwards, broadly speaking.
Yes, 100%.
Right.
I would love to
And
see it. I would love to see it earlier than that, but yes, by October for sure.
right. And then
Sorry, your voice is not very clear, Risha. Hello.
Risha, your voice is not clear.
Okay.
No, we can't hear you, Risha.
Meanwhile, we'll move to the next participant. We'll take the next question from Randeep Pal. Randeep, you can go ahead.
Yeah, thank you for the opportunity. So my question is regarding the 19 stores which will get closed. So how much would be the impact on top line? That is my first question. And we had earlier discussed about 1,000 crore top line over.
Three, two.
Sorry.
Yeah.
Sorry. So one was on the impact of the closure of these stores.
Yeah.
And second?
Yeah, we had earlier alluded about 1,000 crore top line over 4-5 years. So are we on track on that target, or we are need to recalibrate?
Okay. So answering your first question, Deep, whatever figures that we report are post all these closures and everything, right? So now one advantage that we have is, we have a very healthy mix of the channels. So for example, our EBO business overall, all the stores put together, was about 10% of our overall business, right? So even if we close a few bottom stores, the impact on the overall revenue is not going to be so high, number one. Number two, while we are closing the bottom ones, we are also opening new ones. We are still opening new high throughput area stores. So, for example, just giving an example of a new brand, Off-White. We opened one in Bangalore, and we've already opened one in Delhi. And touch wood, the initial response of our Delhi store is fabulous. It's giving us very, very good numbers. Even the Bangalore store, though our floor, the entire mall is not operational, a few brands yet need to come in, but we've been consistently giving good numbers, getting good numbers in that store. So I might have closed a store which might be doing, 5-7 lakh rupees of sales a month. But I've added a store which is now giving me 30 lakh rupees sales a month. I've added a Delhi store which on a weekend is giving me 15 lakh rupees a sale. So it's always a combination. We've always taken a policy that whatever we are doing, we will obviously inform it to the consumer. So don't get this thing by the fact that the company is shutting down 10 stores. What will happen? I think the previous gentleman also was this thing that paisa nahi isliye store band karna. Nothing of that sort. So and we are very much on track to that 1,000 crore journey. No deterring from that.
Okay, yeah, it makes sense. Thanks for the pivot. And my next question is, you have mentioned that you have not lost any market share at company level, but have we lost any market share at brand level, like Tommy Hilfiger versus Urban Jungle or Mokobora?
No. Tommy, in fact, has overall we've remained flattish. But if I see my ASP growth is better, probably volume, there might have been some low minus single digit negative, but ASP level probably we've grown and we are retaining the market share. Only place where I think we've not done to our true potential is, and I'm being very candid and open about it, is yet Benetton. We've had couple of strategies that we tried and which has not worked well for us. We've already revisited those strategies, pivoted ourselves, and we're going on a new path now when it comes to Benetton. So Benetton, we've seen a degrowth in our primaries, but I'm very confident that this year we'll be able to turn that whole business around, and we should be back we'll cover for whatever lost opportunities.
Okay. And my last question, Abhinav, is that since you're cutting the long tail, so currently our inventory days is around 300. So what's our target inventory days? Like our competition mostly has around 120 days, right?
Sales.
Sir, 300 days means we had 128 crores of inventory at March end. Currently, we have about 123 by June end. So it's about 130 odd days of inventory, sir.
Okay.
Yeah.
Okay, then it's good. Yeah. Thank you.
Yeah. All right. Thank you. Thank you, sir.
Thank you. We'll take a follow-up question from Ankit. Ankit, you can go ahead.
Yeah, thank you so much for allowing a follow-up. Sir, when I compare our quarterly results with the other larger listed players, what I
Right.
see is that the seasonality is a little different in our case compared to them. So they have generally Q1 as their best quarter, and Q2 is their weakest quarter. And in your case, it is just the reverse. I think Q1 is the weakest quarter and Q2 is the strongest quarter. Why it is that, and is it going to remain like that in the subsequent quarter as well?
इंटरेस्टिंग क्वेश्चन अंकित एक्चुअली आप अगर देखोगे ना तो 2 years 3 years back and the other listed players that we're talking about, I'm sure you'll be comparing us either with Safari or VIP. If you look at Safari also, if you study 2-3 years back, you're absolutely right that Q1 used to be much bigger. But now I think over the past 1 to 2 years, or if you look at, I think there also you will realize that Q2 has started becoming bigger generally than Q1, and it also coincides with the fact that now even with these listed players, a large part of their business is coming from e-commerce, right? And Q2, you get a lot of primary orders from all these players, and the supply happens because then you're preparing for the festive season, and hence the supply generally happens. The primary filling happens in Q2. So hence Q2 now has started tending to be bigger than Q1.
So we'll have the same Q2 trajectory this year as well. Is it right to assume?
Yes.
And the margin, EBITDA margin trajectory, which we have shown considerable improvement year on year, will that also continue to be there? I'm not asking for a definite guidance, but generally just a trajectory.
Yes, I hope so, because all these changes, all these consolidations, everything that we've been doing, we've done it to make the balance sheet healthy, and hence I foresee that our EBITDA margins will continue to sort of show a healthy trend.
And one last question: is it right to assume that FY26 debt is the peak debt, and probably by FY27 end we'll have debt a little bit lower than what we see today in the balance sheet?
Yes, we do not intend to, at the moment at least, we do not intend to sort of take more debt. Yes, there is I think we've availed the government scheme which was available, and it was prudent to do so. But apart from that, we're not increasing our debt levels. I think we are sufficiently funded for now.
And same will go for the depreciation also. We have done with all our manufacturing. So depreciation for FY27 end should be lower than FY26, or should be higher, or what would be the trajectory in general?
Marginally higher because 26 was not full year.
Okay, yeah, marginally higher because 26 was not full year operation
For manufacturing.
for manufacturing, right? So FY27 would be the full year of operation, and hence the depreciation would be marginally higher. But just to answer your this thing also on another level, in terms of major capex investment, I think we are done for the next 1 to 2 years, until unless suddenly we get we are seeing an order pipeline which is looking very, very healthy for our luggage plant. But until unless we suddenly get a windfall gain and we get 10 new clients even for our manufacturing, and then we need to invest, I'll come back and I'll tell all of you guys that now we're choosing to invest further. But at the moment, I think major capacity expansion we're done for the next 2 years at least. So you will not see any major capital expenditure happening for the next 2 years.
Thank you so much and all the best.
Thanks, Ankit.
Thank you. We'll take the next follow-up question from Risha Mehta. Risha, you can go ahead.
Yeah, thanks. Sorry, I had some network issues. So,
Yeah,
on
yes.
So just on the depreciation and the interest bit, I did hear your response to the previous participant. So
Right.
depreciation, 4 crores run rate that we have seen in Q1, can that be assumed? So around 16 crores for the full financial year, would that be a right number, or would that still be higher?
Manish?
Almost would be same.
Almost would be the same, Risha.
Correct. And then on the interest bit, I think so basically on the debt side, I think what you said was that yes, by FY27 end, we should peak out on our debt. That understanding is right?
Yes.
Okay. And now just on your manufacturing, so we are at somewhere around like you said, 25,000 pieces per month capacity for both PC and PPE. So
Yes, each, yes.
yeah. So, and you said we are at 80% utilization, right? For each.
We are already at an 80% for PC. PP, we are now starting because PP, you need molds, and that's a complicated process. So, cutting a long story short, we've got one mold, and we're getting another 3 to 4 molds, 3 molds at least, by next month end. So October we'll start, and hence I said either by October or max by November we should be at a 80% utilization in PP as well.
So this existing plant or facility, what is the peak capacity that it can reach for both PC and PP each?
So the existing building, if I few tweaking around changes here and there, and we can have another 40,000 or another 2 lines set up in the same building premises. We'll have to make small bit of investments for an FMS sort of a warehousing and all of that, go downs and all of that. But that will not be a massive investment. So this particular building can suffice up to 4 lines, and every line can have a 25,000 peak capacity. So 100,000 pieces per month can be housed over here. Though there'll be a investment required in terms of the machinery, 2 more lines to be set up. So net, just to give you a brief, broad understanding, another 10 CR of investment can give us another 50,000 capacity.
Sorry, 10 CR can give us another 50,000 capacity, right?
Yeah.
Okay. And I did hear that you mentioned that we will also basically, so basically the entire manufacturing facility will not be used for captive consumption. We would even have other clients for with whom we may be doing third-party manufacturing, right? So was it always a part of the plan when we set out this plant, or has it been an afterthought, or if you could just highlight there? And out of this 1 lakh peak capacity, eventually, how do we envisage the split between, captive consumption versus, third-party manufacturing?
So third-party manufacturing was always part of the plan, right from the day we conceived. Even in our backpack unit, if you will look at one of our largest client today is the Samsonite Group. We manufacture a good amount of bags for American Tourister and other brands. So even with the hard luggage, we we always had the vision that we will not keep it only on capital consumption. In fact, to be very honest, I personally believe, I don't know, I might be right, I might be wrong, but I personally believe that of the total installed capacity, uh, neither your consumption should be more than 50% and the other way around also. So I think that gives you a very healthy balance, So we always had plans that we'll have uh, third party clients also. And we are actually in talks with a lot of brands. We also look at I particularly see a huge opportunity of the export market as well. But probably currently looking at all the events that are happening around the globe, it might not be right now. It's a little difficult. It's tough waters, but eventually that could also fuel a lot of growth for us. And we will not shy away from all of that. We've built a world-class manufacturing facility. We've built a state-of-the-art facility. It's 100% compliant facility, so why not encash that? So it was always a part of the plan. How much of whether we go to that 1 lakh today or tomorrow? Again, right now we're good with her 50% capacity, 50,000 pieces capacity, and most of it at the moment, 100% of it is in-house consumption, right? But tomorrow, even if we get third party, I would believe that for some time I would want to run it at this level and keep maximum capacities to be consumed in-house. Then we'll evaluate. Once the plant is running efficiently, all our metrics is in place. Expansion is just a matter of putting in the money and purchasing those machines. So we are ready for that, but
Right. And just the last one is
sorry,
PC and PP is fungible?
PCM.
Fungible.
No, they're not. They're not. So PC is a different mold, different technology. PP is a different mold, different technology.
All right. Thank you.
Thanks.
Thank you. We'll take another follow-up question from Nesar. Nesar, you can go ahead.
Hi, thanks for taking my question again. So on the PP side, right, we discussed this last time also. So for the festive season, will we be launching that because that could be the competition
Yes.
to the lower end?
Yes, 100%.
And what, like, from a revenue contribution, do you see like that reaching what level for this, say, year or season, however you track?
It's too early to say that, but uh, see the cost of production of PP from a raw material perspective, from manpower perspective, everything is better than PC. Okay, so and because today there is this price sort of war which is there, and a price factor which has come in so strongly. We believe this will give us a lot of bite. Okay, how much are we able to bite? How much are we able to chew? I think that will, whether those tiles are successful, not successful. If they're successful, then I can for sure tell you that, straight away you can add up from October onwards, you can add up 20,000 pieces a month, and if I do the math right, 20,000 pieces a month at a average selling price, even if I calculate, say, at around 1,500 rupees, you know, that gets added. But so I don't know how much that would be at a larger scheme of this thing. कितना वो value में आएगा, but I think it will give us the confidence of sort of adding more lines. We will start seeing real volume growth.
Right. But will we be competitive given that, our skill is obviously like maybe in like 1-2% of what some of these larger players produce PP ad. So like will we be competitive from a cost perspective, or will it get more expensive for us actually to manufacture in-house at a lower scale?
No, we'll be competitive enough. See, obviously, if you compare us with say a Safari, for example, they are already at I think a 10-12 lakh pieces per month. And from what I hear, they've again bought another land in Gujarat where they again have bought a land on which they can install another 10-12 lakhs. So obviously, to compete at that scale probably would be difficult, in terms of costings. But the advantage with us, Nisar, is that we're talking about brands like Tommy Hilfiger. We're talking about brands like Benetton, Superdry, all of this. So I feel very confident that we'll be able to sell at certain premium.
Right. Got it. No, got it. Makes sense. Last question is just you mentioned the brands, right? And that's where I wanted to get to that. Besides Tommy, if you can just talk a bit about how these other brands are doing and what is the plan, because eventually they'll also need to fire. So just if you can talk a bit about the hits and misses over there.
Yeah. So I think they've already started firing. See, Superdry and Off-White, I think they're too early to be talked about because we launched both of them in around April. So it's just been 3 months. Superdry, Touchwood, again, initial response is good. Off-White, I think, Touchwood, brilliant response we've got till now. We are already there in Collective. We are already there on your luxury e-commerce platforms. Bangalore store has opened. We've opened the Delhi store. We're going to be doing a launch of the Delhi store in this 5th of September. Then we've already secured a location in Kolkata. And I'm talking the best malls of the country, So Bangalore is Mall of Asia. Delhi is DLF Promenade Mall, right? Kolkata, we are opening in Quest. Next, Q1 will be opening Bombay Palladium. So and I had mentioned this way back also when I taken the brand that this will open up new doors for us, and which it has. So we are now in the top malls of the country. We've seen good response of Off-White, but it's just been 3 months, So Superdry, we are already there in their own stores of Reliance. We're there in about 70 odd stores of theirs. We are already there in Shopper Stop. So it's growing, it's expanding. We're taking our learnings. Some products are working, some products probably not working, but today that entire range is not complete. अभी भी Superdry का luggage नहीं launch कर पाए. Molds have just come in. Trials are happening. So now we'll be launching Superdry luggage. So these two brands are relatively new, but Juicy I had launched last year. And I'm very, very happy to share that, we're doing well in Juicy, in terms of our revenue, in terms of top line. Last year we closed at almost 14 crores, 15 crores? 12 crores. We closed at a 12 crores top line last year. And this year we aim to cross at least a 20-22 crores kind of revenue, in Juicy. So we've been growing strong. We've been, so all these new brands, as I said, are really, really doing well. They are firing, but give it a little more time. You'll start seeing very, very good results after them.
And Benetton, what's the plan?
Benetton, we had some sort of, strategic failure. So when we launched the first time, we went offline first, and then the market crashed. The pricing, sort of crashed, and hence we were we were left irrelevant in terms of pricing in the offline market, in the distribution general trade market. Then we tried to pivot and we said we'll come online, but by then obviously online also was heavily discounted, and a lot of pricing pressure. We had that old inventory. So first and foremost, we had to liquidate all that inventory, right? Which we did. And we had to rejig the strategy. We came up with new products. Backed with our own manufacturing, we were able to lower those costs. And now we are able to sort of segregate two clear, distinct lines. One which we've dedicated to e-commerce, where we're playing that a sharp price point game, and even on the offline side, where we are launching as we speak. We are launching by next month. We will be there in the market launching with new styles and this thing. In Benetton, we have another very good development. So hopefully, we should be starting the CSD business also pretty soon in Benetton. So we should be entering the canteen stores department with Benetton as well. In Tommy, we've already seen that success. We are also, in fact, now introducing other ranges apart from luggage, apart from travel gear. We are also introducing other ranges in canteen stores department. And in Benetton, and we are also now getting into canteen stores department with Benetton as a brand. So we're working on sort of a 360-degree this thing with distinct product for each channel, and then scaling the business.
And Aeropostale, we are like planning to give up, and also any new brand that is any discussions or anything that, or right now the focus is just on these brands.
No, focus mostly on these brands. Aeropostale, yes, planning to give up, to be honest.
Okay, all right. Thank you so much, and all the best, Abhinav. All the best.
Thanks.
Thank
Nisar.
you. We'll take the last follow-up question from Randeep Pai. Randeep, you can go ahead.
Yeah, thank you. So, Avinav, regarding Juicy and Off-White, so how much percentage of the products we are doing in-house in small goods leathers or in luggage?
So, our categories, accessory categories, we are doing completely in-house, not in Off-White. Off-White is a complete import model. Okay. In Juicy, our products we are doing complete in-house, but apparel is completely imported. But now we are getting into getting the apparel also in-house. So we've already invested in the right team, and we are starting with small. We're starting with small India capsules. But I can safely say that this fall winter we'll have a very small India capsule. Spring summer, obviously the capsule will go bigger. By next fall winter, which is Q3 of the next financial year, I think 70-75% of even the apparel line in Juicy should be in-house, which would give us a much better margin.
Okay.
Than the import.
Yeah, and my last question. So, do you have any target about the Off-White and Juicy, the number of store counts over next 12 months you want to roll out?
See, Off-White, we had thought of 5 stores in totality. I think we are done for now. By next Q1, we'll be opening the 4th one in Bombay, and I think we are done for Off-White. Okay. There is a diffusion line of Off-White internationally. They have launched that brand by the name Lab. We've got that as well. But there might be some store plans in that, but we're too early. It's too early for me to talk about it right now. But Off-White per se, 4 stores and we are done. Juicy, we already have 3 stores. I think we're gonna open a couple of more, and then we'll not be in a rush to open stores. We'll understand these stores. We'll take our learnings. We'll do all the matrix. We'll get all the matrices right. Once the matrices are right, once we know that the India merchandise is also doing well, then I think the potential is huge. But next 1 year, we're gonna be cautious, going easy.
Sure. Yeah. Thank you so much. Wish you all the very best.
Thanks.
Yeah.
Thank you, sir. Since this was the last question, would you like to give any closing comments?
No, I think good. Thank you all for joining and taking out time and hearing me patiently. I think just as a closing this thing, I would like to say that we are in a good position, and I'm very happy and very confident that this year should be a good year for us, and whatever uh, bottoming out had to happen, I think has happened. So it's all upwards, up and upwards from here on. So thank you everyone, and thank you for your good wishes always.
Thank you to the management team for your valuable time, and thank you to all the participants for joining on the call. This brings us to the end of today's conference call. You may all disconnect now. Thank you.
Then disconnect me.